Today, we're going to be talking about universal life insurance and how it works. I hope you enjoy. Over the last few years, I've very frequently had people come in and they have questions because maybe either somebody has talked to them about a universal life insurance policy or they've got one and they're getting some concerning letters, especially if it's an older contract, and they don't feel like they fully understand what's going on. And maybe their agent is no longer in the business or has retired or has changed careers, but they want to better understand this coverage that they're owning and they're paying premium into. So today, that's what we're going to cover. And we're going to look at how those contracts work, because they were originally, when they first came out back in the late 70s, early 80s, interest rates were extremely high, and they were billed as a vehicle that would allow a person to capture those high interest rates. Now, they were historically high, those interest rates were. And we're going to look at this, and that's my best impression of a bucket. So this is a universal life insurance contract. They originally were touted as, oh, this is a cheaper version of whole life insurance. Well, something that I learned a long time ago, having been in this business for 30 years or 30 plus years, is there are no deals in the insurance business. Anytime you are perceiving that you're getting something for a significantly lower cost, it's because the carrier or the company is transferring more of the risk to you, and they're taking on less of the risk. Insurance is all about trading risk and cost. So as we look at the bucket, if this were your life insurance contract, basically what we would be looking at, we would say, of course, that life insurance, and this is going to, it doesn't matter if we're talking about a variable universal life, traditional current assumption universal life, or the new kid on the block that has gained a lot of popularity, I can't speak today, and that's indexed universal life. So with that universal life contract, you've got two components. So we've got a cash value, and then we've got a death benefit. So we're going to put a value right there. So this difference right here is net death benefit. And what that simply means is if you have a $1 million universal life insurance policy, and that policy has $200,000 of cash value in it, then the insurance company is on the hook for $800,000 of net death benefit. That net death benefit is the difference between the cash value in the policy and what the face amount of the insurance is. Now, what's never really explained with these contracts, and I think to the detriment of the client, is all universal life policies are built on this same chassis. And effectively what they are is they are a term policy, an annual renewable term policy with a side fund. And that side fund is accumulating the excess cash, and then the interest that's being credited, that's where you get the different flavors. Is it universal? Is it current assumption universal life, index universal life, variable? But here's the thing we need to know. Think of this as when you first start that contract, you got a little bitty pinhole there, and that pinhole is leaking out dollars in the form of mortality costs. Now, in the early days, let's just say that pinhole is the size of a 64th of an inch. Very, very small. So very, very little is dripping out, because when you're younger, mortality cost is less. As you get older, what happens to life insurance? If you think about when you're trying to buy a term policy, even the older you get, the higher it gets. Well, the same thing is happening in this universal life contract because it has a term component to it. So as you get older, this little pinhole keeps getting bigger. And as it gets bigger, more dollars start spewing out. Now, the hope and the objective of this contract is that the return that you're getting on this cash is going to outrun the mortality costs. But what we saw in the original versions was it didn't, because they were designed assuming very high interest rates. And then as interest rates fell, the return on the cash couldn't keep up with the mortality cost. And so what ended up happening is it begins to drain this cash value. So it begins to decline, and you can end up getting an ugly letter from the insurance company, no fault of their own, just the way the contract is designed, stating, hey, this policy is about to cannibalize itself. And if you don't put extra money in by some certain date, the contract is going to terminate. So you've paid premiums all these years, and now you're in a position, unfortunately, this often happens when somebody is at an age where it's too late really to do anything else. Now, there are sometimes some steps that you can take to help shore up these contracts, but just know if you own one of these contracts, as you get older, this little pinhole keeps getting bigger, bigger, and bigger. And this is just going to keep causing more and more dollars to come out in the form of mortality cost. And that mortality cost is what's being used to cover this net death benefit. So the gap between the cash and what the insurance company is going to owe if you pass away. So as you can see, these things, they can get a little bit complicated. And again, you have the different flavors. If you have one of these contracts, or if you have questions about this, please give us a call here at Westside Advisors and Insurance Services. I hope you have a great week.